Hello all, hope you all are doing great. Today we will discuss what is recession. In simple words, a recession is a significant decline in economic activity that lasts for months or even for years. Experts declare a recession when a nation's economy experiences negative gross domestic product GDP, raising levels of unemployment, falling retail sales, and controlling measures of income and manufacturing for an extended period of time. Recessions are considered as unavoidable part of the business cycle or a regular cadence of expansion and contractions that occurs in the nation's economy. If we define the recession unofficially, in 1974, economist Julius Shinskin came up with a few rules of thumb to define the recession. The most popular was two consecutive quarters of declining GDP. A healthy economy expands over time. So, two quarters in a row of contracting output suggests that there are serious underlying problems. According to Shinskin, this definition of the recession becomes a common standard over the years. A healthy economy expands over time. So, if the economy have two consecutive periods of recession, means the economic activity is declining day by day. The National Bureau of Economic Research (NBER) is generally recognized as the authority that defines the starting and end dates of US recession. It created its own definition of what constitutes a recession, namely a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in the real GDP, real income, employment, industrial production, and wholesale retail sales. What happens during recession? During recession, an economy struggles. People lose their work. Unemployment increases. Companies make fewer sales, and the country's overall economic output declines. The point where the economy officially falls into a recession depends on a variety of factors. So, we will discuss each factor turn by turn. Before that, we see that there is much more one way of causing recession in any economy to get started from the sudden economic shock to fallout from uncontrolled inflation. Some of the main drivers of the recessions are explained as a sudden economic shock. An economic shock is a surprise problem that creates serious financial damage. In 1970s, oil producing and exchange countries cut the supply of oil in the US without warning, causing recession. Not to be mentioned, endless lines of gas stations. The coronavirus outbreak, which shut down economies worldwide, is a more recent example of sudden economic shock. The second is excessive debt. When individuals or businesses take on too much debt, the cost of servicing the debt can grow to the point where they can't pay their bills. Growing debt, default, the bankruptcies, then capsize the economy. The housing bubble in the mid that led to the Great Depression is a prime example of the excessive debt causing recession. Then we will talk about the too much inflation, which is also one of the major factors of causing recession in an economy. Inflation is a steady upward trend in prices over time. Inflation isn't a bad thing, but excessive inflation is a dangerous phenomenon. Central banks control inflation by raising interest rates, and higher interest rates depress economic activity. Out of control inflation was an ongoing problem in the US in 1970s. To break the cycle, the Federal Reserve rapidly raised interest rates, which caused a recession. Other factors of recession includes too much deflation or technological change. While running inflation can create a recession, deflation can be ever worse. Deflation is when prices declines over time, which causes wages to contract, which further depresses the prices. When a deflationary feedback loop gets out of the hand, people and business stop spending, which undermines the economy. Central bank and economists have few tools to fix the underlying problems that cause deflation. Same like the technological change, new inventions increase the productivity and help the economy over time. But there can be short-term periods of adjustment and technological breakthrough. In 19th century, there were waves of labor-saving technological improvements. The Industrial Revolution made entire professions obsolete, sparking recession and harm. Today, some economists worry about the robot could cause recession by eliminating whole categories of the job. Now we discuss how long do the recession lasts. NPER tracks the average length of US recession, and according to data 1945 to 2009, the average recession lasted 11 months. This is an improvement over the earlier years. From 1855 to 1919, the average recession lasted 21.6 months. Over the past 30 years, the US has gone through 4 recessions. Number 1, the COVID-19 recession, which is the most recent recession, began in February 2020 and lasted only 2 months, making it the shortest US recession in history. Great Recession, December 2007 to June 19. As we mentioned earlier, the Great Recession was caused in a part by a bubble in a real estate market. The Great Recession wasn't as severe as the Great Depression. Its long duration and severe effects earned its similar monarchies. Lasted 18 months, the Great Recession was almost double the length of the recent US recession. The dot-com recession, March 2001 to November 2001. At the turn of the millennium, the US was facing several major economic problems, including fallout from the tech bubble crash and accounting scandals at companies like Iran, capped off by 9/11 terrorist attacks. Together, these troubles drove a brief recession from which the economy quickly bounced back. Last, the Gulf War recession, July 1990 to March 1991. At the start of the 1990s, the US went through a short 8-month recession, partly caused by spiking oil prices during the first Gulf War. Can you predict the recession? Given that the economic forecasting is uncertain, but predicting future recession is far more easy. For example, COVID-19 appeared seemingly out of the nowhere in early 2020, and within a few months, the US economy had been all but closed down and millions of workers had lost their jobs. That being said, there are indicators of looming trouble. The following warning sign can give you more time to figure out how to prepare for the recession before it happens. A decline in consumer confidence. Consumer spending is the main driver of the US economy. If surveys show a sustained drop in consumer confidence, it could be a sign of the impending trouble for the economy. When consumers' confidence declines, that means the people are telling survey takers that they don't feel confident on spending money. If they follow through on their fears, lower spending slow down the economy. A sudden stock market decline. A large sudden decline in the stock market could be a sign of recession coming on, since investors sell off parts and sometimes all of their holdings in an anticipation of an economy slowdown. Rising unemployment. It goes without saying that if people are losing their jobs, it's a bad sign for the economy. Just a few months of steep job losses is a big warning of an imminent recession. How does recession affect me? You may lose your jobs during the recession and unemployment level rises. Not only you are more likely to lose your current job, it's become much harder to find a job replacement. Since more people are out of the work, people who keep their jobs may see cut to payoff and benefits and struggles to negotiate future pay rises. Investment in stocks, bonds, and real estate and other assets can lose money in a recession, reducing your savings and upsetting your plans for retirement. Even worse, if you can't pay your bills due to the job loss, you may face the prospects of losing your home and other property. Business owners make fewer sales during the recession and may even be forced into the bankruptcy. The government tries to support businesses during their tough times, but it's hard to keep everyone afloat during a severe downturn. With more people unable to pay their bills during the recession, lenders tighten standards of mortgages, car loans, and other type of financing. You need a better credit score or a larger down payment to quantify for a loan that would be the case during more normal economic times. Even if you plan ahead to prepare for the recession, it can be a frightening experience. If there's any silver lining, it's that recession do not last forever. Even the Great Depression eventually ended, and when it did, it was followed by the arguably the strongest period of economic growth in US history. Thanks for watching. Please like, share and subscribe. Happy learning.